Fix it or? Okay, you fixed it.
It's fixed.
All right, well, it's, what is it? It's December 7th, 9:30, second day of the regular meeting of the Board of Investments, call to order. Can we have a roll call, please?
Good morning. Carl England,
Here.
Jack Prothro,
Here.
Terry Cohey,
Here.
Bruce Nelson,
Here.
Diane Fladmo,
She will be here, but she had to be actually had to be in court this morning, but she'll be here.
Perfect. Thank you. Maggie Peterson,
Here.
Mark Berry,
Here.
Jeff Meredith,
Here.
Dan Trost,
Here.
Representative Ken Walsh, and Senator Ryan Lynch. All right, we have a quorum. Thank you.
Okay, well, obviously we are video recording the meeting, so everyone's on notice of that. And is there any public comment on issues within the board's jurisdiction? Seeing none, I'll just simply welcome to the room former CIO Cliff Sheets. It's a pleasure to see you again, Cliff. And before we turn to tab 8, you wanted to
Just information for the board. I was remiss in not pointing out that I had absolutely nothing to do with fixing our finding on the Whipley audit. Peg McEwen did all of the work on getting all of the security done, the lease negotiations, the moving of the folks. It was 100% her, so if you see her, she did a fantastic job on that.
Okay. I sort of assume that about most things.
It's a very fair assumption.
All right.
Just the eye candy.
Well, so tab 8.
Good morning.
RVK, good morning.
Well, Paige is going to start us off with a review of the capital markets. Obviously, a very interesting year. So I'll go ahead and turn it to her. Question for you: do you want us to project on the screen, or you prefer we just leave the faces up and go from your books?
I mean, I look at the book, so.
The book is good.
It's,
If you're referring to the book, be sure to let us know what you're referring to.
Okay, we're going to start in section 1. So it's the short.
Do you have a problem with that,
But there's a lot of charts and graphs.
There are. We'll refer to.
You know, I like to keep control for like 5 minutes.
Oh, it's already gone.
And here it is, it's gone already.
All right, Paige, take it away.
Good morning, everyone. Thank you for having us.
Paige will never come back.
Hazing as we go. I'm going to start on page 11 of the section 1 report. It says third quarter economic environment in the upper left-hand side of the page for reference. So covering the third quarter of 2022, continuing a lot of the market trends that we saw earlier in the year. The quarter itself started off fairly strong, investors being optimistic that the Fed was going to make moves to calm markets, and about halfway through, the Federal Reserve made some comments, ensuring everyone that they were going to continue on the path of trying to tame the high and persistent inflation that we've seen, and that really spooked everyone. So we did see a dive to most risk assets in the third quarter of 2022. Continuing this funky theme that we've seen so far this year with the high correlation between equity and fixed income markets, and that's really what's made this environment so unique. Typically, when we see equity markets decline, we hope to see some preservation from fixed income assets, and that has not been the case this year. So looking at the bottom left-hand chart on this page, market performance, you can see that for nearly every asset class shown here for the calendar year to date time period, there's a very large red negative number there. To pull out a few instances, the S&P 500 index representing large cap US stocks declining about 24% through the end of the third quarter. The MSCI EFA index representing developed international stocks down about 27%, so even more than US equities. Looking at the Bloomberg US Ag Bond Index representing US fixed income, we saw a decline of negative 14.6%, which is a fairly significant decline in a fixed income market. So that is a theme that we'll see in your portfolio as well. Looking at a few of the positive numbers, assets that we did see do well during this quarter. Small bump from any cash allocation in the portfolio, positive return of 0.6% there. The NCREIF Odyssey Index, so that's representing core real estate for the year-to-date time period, positive return of 13%. The one caveat that we have here for core real estate is that there are some lags coming in from those valuations. We do expect to see those numbers come down a little bit once final valuations are in for those core real estate managers. The last one I'll point out here is the Bloomberg Commodity Index representing broad commodities, positive return of 13.6% for the year-to-date time period. And you'll see in your portfolio, really reflective of what we saw from the market here, big declines in the risk assets, so public equities, public fixed income. You did have additive performance from your allocations to real estate, to private assets, and to real assets in the portfolio. Looking over at the Treasury yield curve in the bottom right-hand side of the page, you can see that the green line, which represents the yield curve as of the end of September, is quite a bit higher than the blue line representing the end of June, and significantly higher than the yellow yield curve representing 1 year ago. So that's really a visual representation of the hikes that we've seen coming through from the Federal Reserve. The Federal Reserve controlling the short end of the curve. So as they've been in this hike cycle, we have seen the short end of the curve increase. We have started to see it a little bit here, and this has gotten worse as we've moved into October and November, a slight inversion of the yield curve. So if you're comparing that 2-year maturity to the 10-year maturity, in a I hate to say ideal, but yeah, in an ideal yield curve, we'd like to see an upward slope to it. And we have seen investors less willing to take the risk in that long end of the curve as we're moving into this rate hike cycle. Just to give you some updates past the end of September, because we are in December now, markets have improved since the end of September. To compare some of these index returns that you see here. For the S&P 500 index as of yesterday, we're only down about 15% now. So that is an improvement while still negative. Looking at the Bloomberg US Ag Bond Index, down about 12% compared to the negative 14.6% that we saw at the end of September. So markets have been optimistic that enough hikes have occurred, that we are moving into maybe a more stable environment. That said, it has not been without some whipsaws here and there as the Federal Reserve has come out and made comments about their future efforts to get the persistent inflation under control. A few of the tricky economic indicators that we've been seeing that possibly enforce the Fed pursuing this cycle that they're on is that GDP numbers continue to come in really strong. We see the GDP was recently revised for the third quarter up to 2.9%. Unemployment remains really low. We continue to see these positive numbers come in. So it seems that we are probably going to be in this cycle of rate hikes for a little while longer.
But they're not.
Well, we'll see.
They're chasing a train that left the station already.
Now, do you keep track of that with her or?
No, I didn't keep track of it with anybody.
Oh, okay. That was just Mark.
I'm happy to take any questions anyone may have on this page or the economy in general. I know it's all good
Anything?
news.
Yeah, definitely.
Thanks, Paige.
Well, sorry.
No, please, Mark.
How long do you think it's gonna take to tame this inflation?
We won't hold you to this.
Oh, no, this is in the.
Yeah, if I had a crystal ball,
This is,
the market, I can tell you what the market's pricing in as of right now. The market's thinking that sometime in the middle of next year, we're going to reach the top of the current rate hiking cycle. I don't know, though. I think that, you know, a lot of people 6 months ago thought we would have been in a place that we would have inflation under control.
Yeah.
So,
Well, I don't think people in this room believe that. I mean, when there's and we've been talking about this, but when you have that kind of ARPA money and sloshing around, there's no incentive to quit spending. So I don't know what it's going to take. I don't think Fed actions are going to be the answer.
Well, and, you know, we're dealing with inflation levels that are so high and now so sticky, has moved beyond just food and energy.
Sticky, I think, is the right word.
And certainly, wage inflation has been something that has been persistently strong, although you're starting to see some cracks and layoffs in the high-tech world.
Some, yeah.
But still, it's, the economy's been surprisingly resilient.
Very resilient. That's why, how long is this gonna last?
Yeah, well, you know, certainly, the messaging about lower rate hikes this month and perhaps the next few is a message that the market will be watching carefully, but is, you know, the market reacts, the market being defined as just looking at what equity investors are doing. That should be comforting, but then when the economic news comes in this week is stronger than expected, it's just reiterating the fact that the Fed is using an instrument that they're trying to use effectively after, you know, the train's out of the station, as I mentioned. So it will take some time to get that inflation number down. And it, you know, when you look at what investors are thinking or what their thinking is translated into market movements, keep in mind that we talk a lot about the economy, but the economy is not necessarily the markets. Investors are looking ahead in the equity markets and trying to decide how, you know, is the Fed slowing down? Are they whispering that they're slowing down? Are they
And it's already worked into the numbers.
after September? Absolutely, absolutely.
So another question. So we're not seeing this correlation difference between fixed and equities. Okay, so investment strategy has to change. So we are into private equity, real assets, real estate. Is there any other changes that this board should look at or that our staff should look at as far as the strategy of investing, or is this something that you're going to address for us, John?
Well, you've been prepared for this environment and you really have to be prepared before it happens.
Yep.
To chase it and do something different now. And there really isn't a reason to do something different now in terms of new
Yeah,
investments.
I mean, I think, you know, kind of a short-term, long-term thing, right, Mark? I mean,
Yep.
you know, inflation's high. Is it gonna end next year? Is it gonna end 2 or 3 years from now? I don't know. You know, right answer, Paige. I don't know.
I would maybe put, so page 16 I think is interesting. If you flip forward, this is our quilt chart. Kind of to Becky's point, you know, you compare yourself to a traditional 60-40 portfolio, which would be 60% equities, 40% fixed income. Allocations to the alternative asset classes that you have definitely were beneficial this year. So if you look at the top two charts here, colors on the chart here, so the purple representing commodities and the dark yellow representing real estate, those are two sizable allocations you have in your portfolio. If you had just been in a traditional 60-40, you know, the damage could have been a lot worse.
And keep in mind, this is a historically unusual period to have both these markets correcting at the rate they are.
Right, well, that's the question. Is this an anomaly or is this the way it's going to be?
It feels more like an anomaly. Of course, no one knows. But as we know, the bond market and the equity market are responding to inflation. And the Fed is very active, so they're moving the curve dramatically on the short end of the curve. And so the good news is, and there are some silver linings out there. One of the silver linings is that there's going to be a better yield on fixed income. And there already is. And so that income flow is very helpful for the pension plans and for CAP because, again, it's providing some liquidity and cash flow to pay those benefit payments without selling as much as you would have to otherwise.
Right.
So that will benefit investors in the long term. I think the question, another question that we have is, as the Fed's trying to do their work and chase inflation, is just the way they do it and their stopping point and the economy's reaction to it. And if it's true draconian, pushes us into a deeper recession, obviously. This is a longer term cycle.
And they're afraid to do that quickly. I mean, they have history to show what happens if you do that.
Right. So I think bottom line, and we'll go into section 2 as soon as your questions, after we finish questions on the capital markets. But the good news is you're structured in a way that can benefit from the inflationary environment we're in because you have real assets. And you have investments that are there for long-term growth, which is your equities. Your fixed income, you are in a variety of fixed income markets, but most of it being very core, much more stable fixed income than some other areas. So, and in your private investments, not only are you pursuing those higher return opportunities in private equity, you've also got private credit mixed in, which again is another good diversifying asset with higher levels of yield. So you've been prepared well. The plans that drunk the Kool-Aid, that all they needed to do was 60-40, are feeling a lot of pain right now. And they were dominating the headlines when the S&P was impossible to beat and when interest rates were coming down. Well, you've been prepared for the environment we're in by being diversified for a long period of time.
And fairly short and fixed side, right?
Relative to our index.
Yeah.
And the fixed income portfolio performed well.
Mhm.
I think that was your largest source of outperformance relative to benchmark.
The last question. Okay,
Last one.
okay, relative to these markets and our risk profile, is it an adequate risk profile? Or is there something we should be looking at as far as taking more risk, reducing risk, or anything like that?
Well, the big risk question that we look at every year is really embodied in that asset allocation study and the approval that you made yesterday, because the midpoints and the ranges you approve is how you're going to implement the risk profile that was chosen. Now, we're going to show a page in the next section, in section 2, that will show you where your actual risk return trade-off is, and it's good.
I'll stop.
No, these are very good segue points that are helping us, so. So shall we move to section 2?
Unless there's anything else from anybody, please.
Thank you, Mr. Chairman. Thank you, Paige.
Thank you, Paige.
Thank you.
So we'll go to page 4 of section 2. So it should be a page with a pie chart on the left-hand side that's entitled Retirement Plans. And this shows you the $13 billion that are a combination of the retirement plans. And as typical, when you look on the upper right-hand side, you can see the PERS plan is $6.4 billion and teachers is $4.5. And again, you can see the other retirement plans that are mentioned here, all under $1 billion. The next page shows you some more breakdown in terms of the allocation across the retirement plans, how much is held in cash and how much is held in the CAP X cash. Those details are down in the bottom right-hand corner. I'd really like you, though, to turn to page 6, if we can, to look at a high-level performance review. We'll dive into asset allocation in a little bit more detail a little further back in the report. But on page 6, this is the comparative returns for the retirement plans. And you can see there's a couple comparisons for each plan that's shown on this page. So we have the public employee retirement plan at the top, the net of fees performance. So we've got the line in blue showing that number, and then your benchmark, and then the difference. And the good news is here, although the type is red, and we hate that, it was unavoidable in the quarter out through 1 year based on market performance. The good news is relative to your benchmark, you're beating it handily. And for the calendar year to date, have exceeded it by 3.28% net of fees. The other piece of good news on this page is relative to other plans that are over $5 billion. For the calendar year to date, you rank in the top third, and for the quarter in the 20th percentile. For longer periods of time, you are well in that top third. In fact, many of these periods, 10 years and shorter periods, are in the top quartile, and for 20 years in the 28th percentile. Now, that doesn't mean that your investment policy is successful because it's beating peers, but it's nice. It's a nice comfort to compare yourselves to others that have long-term horizons, that are public pension plans that are larger, to say that your structure has served you very well. And versus your benchmark, you're also performing well too, even though, for the quarter, the return is a negative 3.1, and for calendar year to date, down 12.6. There's the balance of the other retirement plans on page 7 and page 8. But I'll have you turn to page 9 to look at the asset allocation comparison for the retirement plans. This is looking at public employees and TRS. And the structure down below is actually showing you where your allocation is versus a peer group. And the way you read this is starting on the left-hand side. We have US equity, and then right next to it is non-US equity. It's called global ex-US equity. And when you combine those allocations together, that shows you how much equity you have versus peers, which is a bit more than peers. And you can look at US equity in the green diamond compared to other plans, and you can see the various quartiles of plans, those that have very high and then lower US equity allocations. So you are towards the top, not in the top quartile, but you have more than median US equity. When you look at non-US equity, labeled global here, a little bit more than median. When you put those together, you have a bit more equity, around 43% or so, compared to other plans, which you can see is around 37 or so at median. So there's a wide variety of strategies, obviously, that these public plans follow in terms of their total equity decision and their non-US and US decisions. But yours has been a little bit above median in terms of each allocation and in combination. Fixed income, much more similar than other plans. You can see that you have allocated to global ex-US fixed income about 1%. When you look at US fixed income at about 19, that puts you about 20% in fixed income compared to around 23 for median. So pretty close, just a little bit lighter. Alternatives, which is a combination of largely your private equity program as well as private credit, and also some of the natural resources are in this number 2. You can see that you have about a 24% allocation compared to about 25 for median, so very close. But your combination is different in that you have made the decision historically to not be in hedge funds, and that is part of that number for the other peers here. So your strategy has been a bit different. It's been pointed more towards return enhancing strategies rather than the hedge fund area, which a lot of plans use as another diversifier in their portfolio. And then real estate, you're towards the top, and the 10th percentile at your allocation of 13%, the median is 9, especially in an environment where we're looking at the elevated inflation levels we're experiencing today. This real asset allocation is very, very helpful, and real estate tends to respond well in inflationary periods compared to some other strategies. So that's a quick snapshot of how you're structured. I will have you move to page 11. to get to Mark's question, and I was gonna cover this. This is very important. When you look at, in the upper left-hand section, this is a risk return chart for 5 years compared to your peer group and compared to your benchmark. So for that 5-year period, in the upper left-hand section of this page, you are the green diamond and your benchmark is the blue dot. The other gray squares are other plans that are bigger than 5 billion. And what you should take away here is that you have had less risk and more return than your peers. And when we look at the blue dot is your benchmark. Your benchmark, again, can't exactly replicate your actual investments in the private areas. So for example, you're using, as you know, small cap stocks to benchmark your private equity, and you're using leveraged loans to benchmark your private credit allocations. Those have more volatility than your actual real estate or your actual private equity portfolio and your actual private credit portfolio. So there's some big, mismatch, but again, this benchmarking issue is something we've talked about a lot in the past. And I just wanted to explain why that blue dot was so far towards the right-hand side. Any questions on this page? Before we look at the next page, page 12, which is 10 years, even better relative return. That green diamond is up a little further in the chart. So you should take away from this that the asset allocation you've chosen and how it's performed over the last 5 and 10 years is certainly beating your expectations for that are represented in your benchmark, as well as comparing favorably to other plans. And I also would say, when we think about the presentations from the PERS and TERS plans yesterday, and think about the economic assumptions that have been changed this year for the assumed rate of return in those discussions, a lot of the other plans that you see in this cloud chart all have unique assumed rates of return. Many of them are lower. And so this, not only do you need to earn more over time to be helpful relative to your liabilities, but, others haven't fared as well, even when we make the adjustment for what their assumed rate of returns likely are. So a good outcome.
Can I ask you a question? Jack is just hiding.
I have no comment.
Yeah. Okay, so on the retirement funds, when their actuaries do their evaluation, they're doing a 4-year smoothing, is that correct?
Yes.
Okay, but now we're looking at a 5 and 10-year return. Do you guys ever have a discussion, or is there do you get any pushback on this 4-year smoothing on the actuarial study versus if we're looking at long-term? I mean, I agree, you gotta look at long-term because that's what we are. But is there any pushback from them on this actuarial evaluation relative to how they smooth things and how we're looking at things right now?
No, I mean, we give them monthly reports, how they're performing. It includes the quarter to date for the month.
It includes the long-term.
Calendar year, 3, 5, 10, and it's the one that they always go to is immediately to inception to date. I mean, that's the number that everybody just immediately gravitates to, unless they're unhappy. The 27.7 year, they went to inception to date. The down 2 point whatever last year, they'd stay in that first quarter when I got my call after they got the monthly reports. The lineup of the 4-year smoothing versus the 5-year, not really an issue for them.
And I haven't.
But that's their
Yeah.
call.
The smoothing,
Right.
that's their call, yes.
Right.
And is that your call, or is that the actuary's call, or both?
It's the actuary, right? That's the
Well, it's a recommendation, but we approve it as a
That's true.
board, of course.
Oh, okay.
So the actuary comes in and says, we're gonna do this using 4-year smoothing. and you
I think
guys
it's
say-
just a standard practice.
That's what I think.
Right, it's been a standard
But also
practice,
we-
and there was at least for a while, a standard amount of criticism of it, so it was kind of my question I was gonna ask yesterday, but you guys are comfortable with that?
So Mark, I'll ask a question now. You can stare at me.
And only Mark, or can the rest?
No, I don't want you.
So this is for you, Paige. I know you've been working on our account for quite a while. So when you've been doing that and analyzing what we've been doing, is there something that came to your mind that you'd sure like to talk to the board about?
Oh, boy, what a
Loaded
question.
Our coffee isn't that good.
Yeah. I understand you got one guy that's been on there a long time, kind of grumpy.
Are you talking about yourself?
I would just say, remember, we bought you dinner last night.
No pressure.
Yeah, no, it's a big question. I am going to answer it probably not how you'd like to hear it, but it's always nice when I roll onto a new client to see that they're in a position like you are. To be fully diversified across asset classes, to not be taking any huge tactical moves. Your rankings relative to peers are really strong. And it just seems like this board kind of has the long-term perspective on everything. I don't see anything in your portfolio that seems like it was really knee-jerky or someone got really excited about some niche asset class. And while those can be nice for small periods of time, they don't tend to work out over the long term. So in short, no. I would just like to pay you a compliment for doing such a good job.
Well, I'm not used to that, but.
We can discuss that later.
But, one of the things that we've tried to do is have continuous improvement. And so, again, for you, Paige, because I kind of know what Becky will say, I think. But based on the premise that we're always trying to do continuous improvement, just on a high level to the board here, not looking for criticism or anything, but is there anything that we should be doing broadly on our structure or the way we do things? Anything you could think of that would help us to work towards continuous improvement?
I don't think so. I think that, again, you're structured in a really nice way. I think that the way that the alternatives have been evolving, adding in things such as private credit, definitely are helpful to the portfolio. I don't really have the silver bullet for you, I guess.
Well, you answer better than Jim, I'll just say that.
I will let him know that you said that.
We're all gonna let
Was
him
my
know.
answer 1/4 of the length that his would have
Nailed
been?
Hold on, we're gonna pull a Ken Walsh here.
Jim was asking me yesterday if he should log into the meeting, and I said, no. Darn.
Jack, I appreciate the question. I will definitely think on it, and if I have anything more useful to share.
Maybe just to add one thing that you're doing well, but is always going to be a constant challenge. One is sticking to your structure when times are testing your patience, and this is one of them. But another is you have the opportunity as you put illiquid assets to work, as you look at new commitments and the new funds that you're investing in private equity and in private credit, you have the chance to do a little bit of what Paige was talking about. You're not knee-jerking and saying, oh, now we're going to be completely venture capital, or now for new commitments, we're only going to be buyouts. But you get to choose your flavor as you move forward and vote with your feet being the dollars that you commit to these private investments. So it allows you to, private equity is a huge umbrella. You get to decide what that's going to look like as you put new money to work. And it's not as much the case when you look at your traditional asset classes like fixed income and equity, although you've made changes there. Obviously, you're passive in US equity, and we very much support that move. You still have active management in international equity. We also support that move because we think there's a lot of decisions managers get to make. But you've added some new areas in fixed income in the last couple of years, emerging market debt and preferred securities. Those, again, when you look at this year, They don't look great because we've had the US currency being very strong as one element, but also in a risk-off environment, you find things like those types of strategies, especially emerging market debt, to sell off more. So there have been changes on the edges that have been inside these big pools that are exactly the right direction, in our opinion, for the long term. They won't always pay off when we look at the numbers in markets like this. So those are just some additional comments. In terms of continuous improvement, those are examples of continuous improvement.
And Jack, just to overlay that, yes, we've got the diversification, but when we look at it net of fees, we're always focused on the fee side. And if there was one aspect of CQI that I think we're on now more than we have been, it's how do we use the CEM report? How do we know where we are relative to peers? And how do we get those fees down? That CEM report gives us a 2-year work plan on where we need to go get better fees, so.
All right. So let's move to page 13, looking at our investment pools. Obviously, we spend a lot of time talking about CAP. That's 12.9 billion, as you see in the upper right-hand section of this page. We've got STIP at 7.6 billion, and then the trust funds pool at about 2.8. So again, this gives you the big picture of where the asset totals are by type of plan. When you look at page 14, we give you the return of CAP. Again, it's going to look very similar to those returns that you saw for retirement plans because they're holding CAP and then a little cash to the extent that they need to. So a loss of 3% for the quarter, and for calendar year to date, 12.8. Notice that we don't have a peer rank for CAP because we're ranking your retirement plans, and there really isn't a peer group for a retirement plan investment pool like CAP. You can see the trust fund pool returns look better on a calendar year to date basis because again, there's real estate in those investments, which really helped the very difficult fixed income market, but they also don't have that equity exposure that had the bigger losses during this calendar year to date. And then STIP, you're going to start seeing better returns in STIP as the yield environment has been changing. And the fact that for one quarter you got a 32 basis point positive return compared to the calendar year to date, you can see how much that's changing. For 9 months, you're going to be about twice that. So again, you can expect that those returns will continue to improve because of yields. Yes.
Quick question. So I'm trying to find the right page to compare, but I was surprised to see the performance relative to the benchmark on the trust fund investment pool was less because normally we're above on all the bond things.
Yeah.
What's going on there?
Well, some of the things that are going on, for example, some of the high yield managers in that space are a bit below their benchmark.
They're less speculative.
Yes,
Gotcha.
exactly. That's one of the things. And,
Okay.
We'll look at some of those details, including real estate in a moment.
Okay.
So on page 15 is the CAP. You can see the asset allocation. Again, this was discussed yesterday. But in all, you've got about 42% in equity, about 20 in fixed income, real estate about 13, real assets 6, and private investments 18. The next page shows you, now peeling back another layer of the onion in CAP, you can see the asset class returns. And here in domestic equity, this is a passive program, so we're not expecting any big differences versus the benchmark. The absolute returns, of course, painful in this environment, but as Paige said, we've seen some real improvement in this since the end of September. International equity, there's active management and passive in the structure. I'll show you what that looks like. For the quarter, beating the benchmark, a little bit behind for quarter and year to date. You've got growth and value managers in that structure. Again, a very rough period for growth managers, and one of the value managers was underperforming the benchmark as well. But again, a very tough period for active management in this short period of time. Longer term, you can see that you've performed well. So there's no burning issue in international equity at all. And actually, to the extent to which some of those managers use emerging markets equity, it was a particularly painful period of time for emerging as well. Core fixed income, you've got divided into these two elements. You've got the core and the non-core. In the core, you can see the loss of 4.5%. In some of the non-core, you may say, well, why didn't that correct as much during this period? Well, we'll look at some of those details, but in some cases, when you look at some of the high yield fixed income, they had a better yield going into this environment. And the duration, again, losses just reduce that overall return. But when we look at a lot of other plans, public plans, we actually find them combining those two areas. So when you look at ranks, you kind of have to take them with a grain of salt. Many just combine their non-core and their core together and have one comparison versus other plans and versus a core benchmark, which is a little bit of cheating in our view, but is something that's been pretty traditionally done in the investing space. So very, very painful period for fixed income. Real assets, positive numbers. This is so nice to see. And again, a good part of your diversification plan. A positive return of 1.3 for real assets. This is again the former natural resources composite, and 10.6% on a calendar year-to-date basis. So very welcome. Real estate, a nice return, mostly driven by yield in this quarter, a 1.6% rate of return, 11.3 on a calendar year-to-date basis. Last year was the best returning period for the benchmark in real estate in history.
Wow.
So coming off of a very strong period for real estate, expect that, as with all things, returns will not be just shooting up in relative price, and returns will probably be more driven by lease payments, which is what we expect to drive core real estate, which is a portion of your program. Finally, cash, and then your private investments, which again, primarily we're looking at lagged valuations here, but a positive return for the year of 7.3. But again, there's a lot changing in that world and much yet to be marked to market. So that's just a view into what's been happening on the returns versus the benchmark for each of your major asset class tools. If you look on page 17, we can see how those ranked compared to public plans, actually of all sizes here, so we have enough comparisons, but we look at what their US equities did, what their international equities did, et cetera. You can see what the ranks are. Again, you have passive in US equity. A lot of other plans do too, especially larger ones. So the relative rank is just information. For international equity, again, if you had a plan with emerging market exposure, which you do on a dedicated, and then add also the managers that you use can go there as well. That tended to affect its rank. Again, you've had good performance versus your benchmark, so I wouldn't put a lot of credence to those ranks, but recently they've been about median. Core fixed income, cautionary note on relative ranks, because other public plans, although this is called a core fixed income median here for the results database that we use, that relative rank shows you how good your core program is, but the relative rank that you see under high yield for non-core fixed income, take that with a grain of salt too. Because again, as we look at this program, there's a lot of things that get thrown into that and a lot of different risk profiles of high yield. So we're not concerned as we look at those relative ranks. We just know what your managers are doing. We know they're a bit more conservative, and we've got elements in there that are recent additions that we think will be additive in the long term. Finally, the trust fund pool is being compared to fixed income because we don't have a large universe of other plans that have that similar kind of non-core fixed income or high yield specifically, and real estate combined with fixed income. But if you compare it to just fixed income, which is what that program started with years ago, and has since been diversified, your performance is ranked very well. And in real estate, again, you've been in the top third for the most recent quarter. Longer periods, again, are a little bit below median there, but you have a very different program than a lot of other public plans that are more dominated by core strategies than non-core. So bottom line, there aren't a lot of issues to talk about today in terms of, does something need to change? Is something kind of a chronic underperformer? Do you need to consider additional diversification? We think your program is performing well, and we could stop there unless you have comments. Obviously, there's details that get into the various types of equity that you have in non-US and the managers use, same with fixed income. But in the interest of time, I could also stop right there and say there isn't any big recommendations in our reports today.
Questions? So my question always goes to the managers. I mean, what do you see?
See, I was gonna ask that because I knew he was going to.
Any specific manager, Carl?
Well, no, I mean, you look at these, that managers, and, I mean, are there things, managers that concern you, or? I know we tread lightly on this
Yes.
because of the public nature of the whole thing.
Sure.
So, and
Well, Carl, I'm glad you brought up the question because I would like to give you a few tips that I use in looking at managers. So
now
let's,
you give me these?
well, help them today and the next meetings. It's something I remind myself constantly. So look at page 34 with me, if you would,
Okay,
please.
34?
34. So this is
Okay.
looking at your international equity managers, and it
Yeah.
actually continues on to the next
Which is right
page.
where I was, and
I
as you know,
figured.
that's right where I usually end up.
Okay, so let's look at a couple of examples. Now, there's a lot of red on this page, and it's
There
hard to
is.
focus because there's a lot of red on the page. You couldn't avoid it in this kind of environment, but let's use a couple of comparisons. You have different styles of management in these managers to make a healthy international equity program at the core. So you have value managers, you have growth managers, you also have some indexing as well. But let's look at a manager like Acadian. They're a value manager. When you look at that information, it's towards the top of the page is the net of fees performance. First of all, you look at what have they done for you lately? In the quarter, they lost almost 9%, but they're 1.5% above their benchmark. And for calendar year to date in 1 year, they're a bit behind the benchmark. Now, you say that, okay, this manager didn't add value for calendar year in 1 year, but compared to other managers, how did they do? Their ranks compared to other value managers in their international space are top quartile. So this tells you in a couple of those periods, it was tough to beat the benchmark, but compared to other managers are doing well. Now, the thing that I really wanted to bring up, Carl, was on the right-hand side of this page, we have since inception. So we have net of fees returns since inception, and we have the inception date. You can make a judgment about Acadian because they've been in the program since '06. They weren't just recently hired. There's been a variety of cycles. Value's been out of favor for a good deal of many of these performance periods that you see, but now it's in favor. So one thing to take away is versus their benchmark, since inception, they've added 176 basis points over their benchmark. Pretty significant value add, and that's net of fees. Compared to their peers, they're in the 32nd percentile for that entire period. Clearly, there's no issue with Acadian. And on a year-by-year basis, they really haven't tested your patience much, versus the benchmark and peers. So this is an example of a manager that's easy to love right now. If you look at a manager that is something where we say, gosh, this is something just warrants monitoring, but we're not making any recommendations at all. But if you look at a manager like Bailey Gifford, you look at the numbers, first of all, and they're much more negative for a calendar year-to-date basis. They are a growth manager. They were right in the way of what was really struggling the most as we turned into this calendar year and into this very volatile environment we've been in. And you see their relative ranks have been pretty poor. Now, if you stopped your eye from looking at anything but the annualized periods of 1, 3, 5, 7, and 10 for any of these managers, you do miss some of the messages in this page. And that's why I wanted to bring it up. First of all, if you go all the way to the right-hand side and you say, gosh, they're really struggling right now, For the calendar year to date, they're underperforming their benchmark by 8%, for 1 year by 9%. What is going on here? Well, they have been exposed to growth, which has been additive as we look at the last couple of years until we got to this year. So it's a style thing, is explaining a good deal of it. If you look since inception, they've been very close to the benchmark, even with this near-term severe underperformance. And versus peers are a little bit below median. But would you call it, hey, this is a problem manager? Not at this point. In fact, if you look now to the left of the since inception, look at the path of what their returns have done in these periods. There's no clear path of underperformance in every year. It's been an off again, on again type of performance record so far.
Excuse me.
Oh,
Are you
yeah.
comparing it to the growth index? So the
Yes.
fact that they were in growth, we're comparing them to growth, so that
Yes.
shouldn't be a factor. I guess I'm not understanding.
Well, you have relative degrees of growth too.
Okay.
You know, the index kind of divides that world into growth and value. And if you have a deeper manager that takes an even more growth-oriented tact, or if, in this case, if they had more exposure to emerging markets during this period, it would have been more painful. So you are getting an indication that yes, versus their peers, they are struggling recently. And, but if you look at 2021, same message here. But when you look at 2020, they're in the 13th percentile and beat their benchmark by 12%.
Exactly.
And, 9th percentile beat their benchmark by 7%. So that's why analyzing these managers is never only about annualized periods or what have they done for you recently. It's what do they provide for the portfolio, which is a growth-oriented exposure, which you need. So we'll continue to keep an eye on what the other growth managers are doing and their relative performance, and keep an eye on that since inception period to say, gosh, is there someone better to consider for this period? And we're not at that point.
Thank you.
Is the ranking here compared to other managers doing the same thing?
Yes, other growth managers.
Other growth man?
Mhm. Yep. And I wanted to point out to one probably that you had seen, Carl, when you were looking through the managers, just to explain that obviously there was a lot going on in growth during this period. And also, the decisions they're making on a security by security basis would have an impact here. How much they have in emerging markets is going to have an impact here. But at this point, Bailey Gifford is a highly ranked manager going into this period. So we haven't lost faith that they know how to perform and to make good decisions in the future, but we'll monitor them. And here you've got a lot of tools to do that, to ask the questions of staff and of us, what's going on? Does that help?
We don't have a monitor list per se, right?
A watch list?
Watch list. Would that be?
Because we're always watching.
Yeah, that's the thing.
Good
And
answer.
yes, there are some plans that have watch list criteria, underperforming the median or the benchmark by a certain amount over a certain period of time. And the whole purpose is a watch list is not a terminate list. If it was a terminate list, why are you just watching? A watch list just, but when committees like yours or boards like yours see plans that do have a watch list and they look at the names on there, in their minds many times that why aren't we terminating them? They're on the watch list. I have a client that sets their watch list every year based on the year's peer ranking. And we haven't been able to convince them to change it, except to convince them that a watch list is not a terminate list. Because every manager will spend time on the watch list based on that criteria.
But using Bailey Gifford
Mhm.
versus Acadian, so we got a value versus a growth.
Mhm.
So on the international side, should we be having discussion about how much growth allocation do we want to put at this point versus value, or what kind of investment strategy we want on the international side?
It's important to be in both spaces, long-term, consistently. Because one of the things that you'll find is some people may look at the growth cycle we had in the US that ended last year and said, everyone should have known that would end. But the magic part of that, because nothing will grow to the trees won't grow to the sky. But the problem is no one knows what day that's gonna happen. And is it consistent, or is it gonna quickly move back to the patterns it had before? So it is very hard to force yourself to keep both, even when one style's not performing well.
And I would say, Mark, that we are having those conversations as staff about where we should allocate. In fact,
Right.
Jason and Steve and I were talking about that quite a lot just last week in our meeting of, do we want to make any changes within the manager lineup? Not in terms of getting rid of somebody, but do we want to allocate more dollars from passive to active or within the managers? Because Bailey's had a rough time here, no doubt about it. But historically, like Becky said, we believe they're a good manager. Is it time to allocate some capital back to them because we think they will rebound from this type of downturn?
Rebalancing.
So, those discussions are happening. I guess I would respectfully submit that I'm not sure getting in the weeds at that level with the board on a regular basis would be
Why?
respectful.
Yeah. Okay.
So if I had to summarize the manager level discussion, or when you're prepping for meetings, keep an eye on what they've done recently, but more importantly, look at the year by year and the since inception before you draw any conclusions about, hey, should I be concerned about this manager? And then call your staff or us.
Dan?
Yeah, I have I guess the same question that Mark had relative to the domestic equity portfolio. I know it's indexes, so it's not as exciting, but I'm just wondering if it seems like during my career, there've been a couple of times where it's looked like valuations were stretched on either the growth side or the value side, and maybe making an adjustment there might be warranted. We don't know when it's going to revert to mean, but it always does. And I think back to 1999 or something,
Yeah.
when growth valuations were just ridiculous, and that would have been a good time to try to avoid some of that. It doesn't look like we even have the ability to do that because we're just straight domestic equities. Is that something that other boards maybe look at and try to add some value, or is it just not worth it in your mind?
Well, it's a great question. The question about should we, say you're at the end of 2021 and you're having an asset allocation discussion and you're looking at US equity versus non-US equity. Most boards were really struggling with adding more to non-US equity when their US equity had done so well, even though if you believe that the prices of investments make sense to watch long-term and that you should pare back an overvalued asset to look for possible increases in lower valued assets. So a lot of boards were really challenged with that discussion. And because a lot of them have liabilities in US dollars here in the country, it made it more comfortable to have that home country bias. But with your structure here, you've got the advantage of having the midpoints that you just approved and the ranges to allow you to adjust to that paradigm if it feels that the US equity is getting a little bit overinflated as staff has their discussions and moving about the range and John's considering what decisions to make. He can actually operate within that range to actually express that view a little bit.
Even with regard to growth versus value within the US space. Can we?
No.
Yeah, we can.
So we don't
You're
have,
in
we don't,
index to neutral.
we don't
Yeah.
have, we don't have growth and value portfolios that I could move. And the reason, Dan, is I think to answer your question is, a few years ago when we went passive, we did look at, because that was a big piece of the program at the time. We had growth and value managers, and we basically came to the conclusion that people aren't able to pull the trigger at the right times.
Yeah.
And make that shift back and forth consistently, at least. I mean, not to say it never can happen.
It seems like the opportunity is it's only obvious in the rearview mirror.
Yes,
But
so true.
but there are times where the valuations just get so out of whack that if you had even a systematic approach to say, we'd like growth and value equally, if our growth ends up being 2 times our value, maybe we rebalance.
I mean, I guess couple things. Well, there's usually that longer term focus, and then, the timing piece of it is just difficult, but you do recognize that there's a valuation discrepancy there. So there are some pieces within the portfolio. So for instance, we have the ability to over and underweight small caps. So if you look at that universe, there can be a growth component, there, or maybe in the S&P 500. So we've got like S&P 500 ETF. So if we're looking at, well, where do we want to take money from? More recently, we might have said, oh, well, the FANG stocks are making up such, a lot of that growth, quote unquote, was driven by the really, really large players there. So, okay, does S&P 500 look a little more expensive versus small cap? And, so there are some tools there, but it's not kind of that, as you're saying, directly a growth value perspective. And so we do think about that at the margins, but ultimately, kind of arrived at, especially in domestic, the ability to, I guess, beat the market in that fashion is just extremely difficult because of the efficiency essentially within the U.S. market in particular, whereas international a little less efficient in our minds, and that was kind of borne out by the research and the data that Jason and Steve had put together.
But that raises an interesting question is, so we made that decision, what, 3 years ago? 4 years, 2 years ago?
Active.
Well, 2 years ago.
2 years ago?
We started at 3, made the decision.
That's right, yes.
At what point does the board say to staff, we made that decision,
Revisited.
yeah, when do you revisit it?
I
mean,
would
is it-
argue you have the work plan, and it's our obligation that when public markets comes up again, to go back and view, hey, what major decisions have we made in the portfolio since the last time we were here? And have they panned out as we expected? And then also at that point, is that an opportunity for, constant quality improvement? Is there, some sort of systematic metric we could build in to do something like that? I think that my fear on getting too far into that active, passive growth value timing is that's a lot of work, and we made the decision to shrink the team down, avoid the costs, and just place let John and Jason and Steve do some of the small cap overweight is sort of the gear we have, or the lever we have to move that. The other piece is the microscope we're under is a lot different. So if we time it wrong, it's a different reaction than if, an individual decides they're going to try to time that growth value switch. So things to think about and things we will touch on when we talk about public markets next time. But to me, the appropriate direct response, the appropriate time to review that is you set the work plan, you've laid out when you expect us to do those sorts of reviews, and it's incumbent on us to do that.
I think.
Well, and I also think it's incumbent upon board members at that point. Tell you that maybe instead of this year giving us the standard overview, why don't we delve into this question? I mean, I'm not saying that, and I'm not proposing that we delve into this question the next time. I'm just saying, I think that's a good reminder the board members should be able to.
It's extremely helpful if we have something coming up on the work plan and you've got questions about it.
Right.
Let us know ahead of time and we can build that into the conversation. But yes, I mean, it's a question that's been asked by a board member, and damn right, we're gonna talk about it in the next presentation.
Could I just offer, Mr. Chairman, another thing that we do every year, and we'd welcome that if we want to include it in education, or certainly we'll work with John and their staff. We actually look at this question every year in a rolling 3-year evaluation that goes back to '01. Looking at all active managers that are in the research database that we subscribe to. It's called an active passive study. And we look at all styles in US equity, all styles in non-US equity, styles in fixed income. To see when you look at active managers and what the results have been on rolling 3-year periods, going back over all those time periods, what the trends are, and is a median manager adding value net of fees versus the benchmark? Now, and have they? And what is the likelihood that you could get a top quartile manager? What would be the reward for doing that in any particular style? And in US equities, especially in large cap, that value added has been so small or negative. So a lot of systems have just continued to put resources, as Dan said, in asset classes where active management has been more persistent. So we'd be happy to include that, or certainly, provide it to see if that's helpful. So that's a diligence point that we look at every single year.
Okay, any other questions before we move on to John and team? If not, thank you. Hey, thank you, Becky.
You're welcome.
Tab last.
Tab last.
Tab last.
Tab 9. All right, investment updates. Thank you, Mr. Chairman. I will make it quick because I know you wanted to show us some of your moves from when you were.
No.
Yeah.
That's not happening.
Get through this.
Moving right along.
Slide 4. CIO update, the retirement plans net performance. So we kind of were talking about this slide yesterday a little bit. So you can see, although the colors got a little crazy, I think on the 1 year there, that is a negative return, obviously, in the dollar value add, which it's circled in red. It's just not fully red. I'm not sure why that happened, but some negative performance, as we talked about, for the year, combined with our net cash need to pay benefits, dropped our overall asset values for the year, but more importantly, over the 5 and 10 year timeframes, obviously, significant addition to our overall assets in excess of our benefit payments that, of course, we need to make on a regular basis. Moving to slide 5, the overall changes within the portfolio, just broken down here by the asset classes. I guess the main comments I would have here, just kind of net cash flow out of the various asset classes here. It's kind of across the board as you see. For the most part, most of the rebalancing that sort of occurred over the course of this year within domestic equity and international equity actually took place more in the fourth quarter of last year, when we were still having the strong run up and domestic was actually beating international. So that was kind of the majority of that change between domestic and equity, sort of rebalancing back into international, as Becky was talking about a little bit. Other than that, strong realizations in private investments, as we've talked about before, particularly late last year and early this year. That has, since slowed down for obvious reasons. And then just kind of pulling a little bit from some of the other asset classes to meet benefits as we are able to, and as we can find and tap liquidity there. Any questions on any of that? All right. Slide 6, just a similar slide, but broken down by the individual pension plans. Obviously, PRS and TRS, the biggest ones there, as always. Performance on slide 7, as Becky and Paige already noted, negative performance here in the year, of course. But when we look out at those longer term numbers, 20 years since inception, still a pretty healthy, reasonable number, and notably in excess of the current actuarial hurdle for pension plans. Slide 8, again, Becky and Paige did a good job of covering all of this, but, double-digit negative returns in all of the public asset classes, and kind of double-digit positive returns in all of the less liquid asset classes, some of that certainly being the lag pricing effect, but some of it also being that, real assets, in particular, there's some strong performance there, is that there's some inflation protection embedded in some of those assets. I would say on the private investment side, of course, we've got private credit in there, which is generally floating rate oriented debt, so that gets hurt a lot less by rising interest rates. And a lot of the companies and things that the private equity managers tend to have would be more service-oriented businesses that are better able to pass on price hikes. And that's been a fairly consistent theme, I would say, that I've heard, and Thomas and Ian, as we've been traveling over the last quarter or so to a lot of the AGMs, that most of the private guys seem to be weathering the current storm relatively well in terms of earnings within the companies that they have. So any questions on anything on that slide? All right, moving on to slide 9. Midpoints here, still well within our ranges, a little bit off of our midpoints, and most of that has really been driven by market moves by and large. As RBK noted, public markets have rallied a decent amount in the third quarter here, so that has pulled us a little closer back. But even with the changes that you made yesterday, I would say we are still going to be relatively below the ranges in the public market space, and probably a little above the range in most of the more illiquid private asset class.
So John, I have a question. So
Yeah.
I know we made adjustments and yesterday we looked at the real estate allocation, but if you're above your range or above your midpoint, what do you guys have discussion about? Okay, we're gonna pull back on looking for investments in the space, or how do you approach that?
I would say, generally speaking, no. So we're looking at the pacing plan for the most part, and it's steady as you go.
Okay.
Maybe, at the margins, probably not increasing our pacing. But we're probably going to be approximately where we were prior year. Now, I say that always because it doesn't matter on the year. To the extent that we can find good opportunities,
Right.
We're going to hit our pacing. If those don't exist, we're not going to force it and go invest in somebody just to put money to work. But we also don't want to be pulling back in those spaces, particularly at times like these, because oftentimes, 5 years, 10 years down the road, you realize, oh, that was the best time to be investing in it because everybody else was doing what you're saying, and pulling back from that. Opportunities are better. So. So slide 10, I just wanted to put this in here, kind of another data point. So RBK does correct me if I get any of this wrong, Becky, but they survey each year. They put out a report that they've surveyed all the public plans, 69 of them, I think it was in this instance, that they got responses from. It's similar to the peer data that we see in the report that you just went through with RBK, but it's sort of a different look, and we can actually see who the participants were in that particular report that they give us, and it also has a lot of drill down to what do those plans hold at kind of more sub-asset class levels. So what are they holding within real estate? Is it industrial? Is it multifamily? That type of information, that's all helpful to us. But I wanted to reiterate, I guess, what we've already just talked about, which is pretty good performance over the long term, and I can see the players, and at least in this survey, I don't know who's who on this, other than ourselves, obviously the green line, but it gives me some comfort, I guess, as I hope that it does you, that, yeah, we're doing a pretty good job. And again, as we've talked about, they have different goals, different actuarial hurdles, all of those things, so I don't want to make, too much of it. But, it's a good job, and, it's a credit to you and the structure that we have here and how we have created things and the good governance model and, your delegating to staff a lot of the responsibilities and allowing us to go out and find the opportunities and execute. And I guess to me, this is just proof that that is working. So just one more data point to kind of hammer that idea home, I guess, if you will.
These are public, these aren't retirement plans.
These are not just retirement plans, they're all public plans, a lot of retirement plans,
Mostly.
though, mostly. There are a few municipal type permanent plans and things like that. But yeah, it's the names I would expect to see when I'm looking at something like this. So slide 11, economic environment. Again, RBK went over a lot of this stuff. I won't, cover every one of these. I put some data points out here, and I would just kind of note broadly mixed signals in the economy as the Fed continues to raise rates. I think we're in an environment where good news is bad news at times. So, we get a really good print for payroll that we had last Friday, and the market hates it because that means that maybe the Fed's going to keep raising rates further than they thought they were going to. So it's very difficult. In fact, I even struggled like, well, is it red or is it green when we have a good payroll report these days? I'm not exactly sure. It should be green in my mind. But just noting that there's definitely a very mixed picture out there at this point in time. And, these are some key metrics that we are watching at this point to try to figure out, where are things headed and where are we going. Slide 12, I put out a number of these things over the last several quarters, but, the unemployment rate remains very low. And certainly that is a driver of inflation ultimately, because to the extent that people have jobs and they're getting raises, that is going to continue to kind of push inflation. So ultimately, the Fed is looking for some demand destruction here, if you will, and that probably doesn't happen until we start to see lower payroll numbers. So we can see it's come down significantly. The blue line there is, employment effectively, and we can see that, at 263, which is what 263,000 new jobs printed in last Friday, that is still well above numbers that we would have seen kind of coming into the pandemic. It would have been a very strong number prior to that. Of course, we had kind of the big dip, and then blowout numbers coming as people came back to work, but they're still very high. They're still very strong, and so that may keep pushing inflation forward for a while. And labor force participation remains relatively low as well, as we've talked about a number of times in recent quarters, which also goes towards wage inflation remaining reasonably high. Slide 13. Again, Becky and Paige talked about it a bit, but the Fed obviously is raising interest rates, as we all know. At least when I did this slide, was it November 14th, this was what the market was expecting the Fed to do in terms of rate hikes. So getting to 5% on the short end-ish, probably in that ballpark even today. I think the argument with the market right now is probably more, well, maybe where that terminal rate actually ends up. Does it go a little higher than 5%? And even more so, how quickly does the Fed really start to cut rates? Because the market is at this point sort of expecting that rates peak and then the Fed starts cutting. It seems to me like that's an unrealistic expectation. I think they'll probably, get to some level or another, and they stay there for probably longer than the market expects, at least at this point. But remains to be seen. Slide 14.
John, but do you agree with the slide that middle of next year that they'll kind of cap out on their actions, or and just stay there?
I'm going to fall back on Paige's answer. I don't know. That's and nobody does.
If he did, we couldn't afford him.
Right, right.
Good quote page.
I-
We're gonna be hearing this for years.
I think it's likely that we peak somewhere next year, at least for a period of time, because it's a very blunt instrument that the Fed has, and they have raised rates very quickly here. You know, this is not something we've seen probably since the seventies.
70s, 80s, but they're
You know.
not doing it as
I
aggressively.
mean,
as
we're
they
not,
did
we're
in
not
the
as high as
70s.
that, right, but the rate move, you know, we've gone from zero, we're talking 0 to 5
Yeah.
here essentially in the course of a little over a year.
Okay.
So they're going to want to see the effect of that because it does take time. But, you know, the question, you know, really becomes, does it have the desired effect? Are they able to remove all of the stimulus that has been poured into the economy from, you know, all these various things? And if it has the desired effect, then yes, inflation will start to come down and maybe they'll get more comfortable. But if it doesn't, they will keep going. So, you know, unknown. Slide 14, you know, why we're concerned about it, Mark, and why we probably don't know yet is that we have seen core goods inflation come down, so cars and refrigerators and what have you. On the services side, we have not seen that come down, and of course, in the US, the service sector is the biggest piece of the economy. So there's still a lot to be concerned about in that space. And I think that's ultimately the big worry and why we don't know where the Fed actually ends and do they get that back under control. So slide 15, few updates here, I guess. You know, I think I put the same basic bullet point here. You know, there's still a lot of uncertainty out in the market. But the Fed and global central banks, what they do and how long that takes is really probably one of the central questions by far. In addition to sort of the geopolitical conflict that we've obviously seen, and that is always a wild card, but seems to be, you know, maybe a little more prevalent now than it has been during some periods. So a lot of things out there to be concerned about. We continue to maintain liquidity in the portfolios. So, you know, recently here we talked about fourth quarter, we've had a decent rally. A lot of people would call it a bear rally. Last couple of days would probably bear that out since it has gone back down. We have tried to be better
Dead cat
sellers.
bounce, I like that one. Dead cat bounce.
Dead cat bounce, yes. You know, we've tried to be better sellers here when we see that happening, you know, not in a huge way, but at least to make sure that we're raising cash when we're seeing that type of thing happens, because we know we have to pay benefits. So we were sellers last week of some domestic equity and international equity just because we'd had dead cat bounce and felt like that was a good time to take a little bit off the table and make sure we had benefit payments for the next couple of months anyways, tucked away. And for some of our capital calls that we know will happen over time as well. Ongoing investment manager due diligence, you know, I just mentioned that largely in the context of, we obviously had a recent departure, so Thomas and Ian and I have, you know, hit the road and tried to make sure we're making contact with all the managers, and they have questions of us, as, you know, are things changing, or strategies changing, or your needs changing?
You're asking all your managers if they have boat slips?
We're thinking about putting that into due diligence questionnaire.
New
going
DDQ,
forward.
yeah.
It may actually show up in the background checks when we run internal assets if the boat is big enough.
There you go.
So, you know, just ongoing due diligence really, but you know, making an effort. And some of that comes from obviously the pandemic era. I think maybe private side's probably been open more so for a while. The public side, public market guys are feeling more open probably this last 6 months or so than they probably have been prior. More people coming to us. more willing to have us in their office, so, maybe a little bit of making up for lost time. We're certainly, I guess I would say, full back on in terms of travel schedules as we typically were pre-pandemic. We mentioned it a little bit, public markets, based on the CEM feedback that we got, taking a look at international in particular in terms of fees, because we looked a little bit high there. I've already made some changes in terms of looking at some of the ETFs that we had. I think we might have mentioned some of that prior, but we found some other ones as well where we were able to move out of an existing ETF into another one that we felt met the same need, had adequate liquidity, but was at a much lower fee. So we've made some progress there, and Jason and Steve are in active discussions with some of our managers about, hey, we need to talk about fees, and so I think we'll make progress there over the next 6 months to a year for sure. Ongoing work with new and existing clients. We've got a state fund meeting tomorrow. We'll have a lot of legislative changes and cash flows coming, so a big chunk of that falls on the fixed income team and takes up a good piece of their time. It's nothing new, but ongoing improvements, Jack.
So are you seeing new clients?
We see new funds every so often, yeah, absolutely. I'm always amazed because I think, how can there be some new separate account, but there's always something that comes up. And we're happy to jump in and help, so.
During our entrance visit, whatever, with the auditors, they have a process to go through state agencies. They did it several years ago, identify where there's cash that isn't here. So that is they'll probably re-up that cycle in the next 2 to 3 years. So, Department of Ag had 2 new separate accounts.
And there's always settlements and things that are.
So I see more coming.
Solovis Risk, going pretty well. I was talking to Maggie last night, she's like, says, well, is it everything we expected? Well, it never is exactly, but it's been good. We've got all the data loaded. The data looks right. It's clearly a good database. I would say, it's probably more complicated from a reporting perspective than we would have thought, but Matt and Aaron have done a great job of digging in and understanding it, providing reports, and we've kind of gotten close to a point, I would say, where we can sort of replicate what we had, and now we're hoping to move forward to, okay, how do we use this in new and different ways? And I think you will see that, I'm hoping at the February, we need to have, really a major revamp of a lot of this reporting. A lot fewer bullet points and a lot more charts and graphs that hopefully are more easy to digest than what the bullet points are. So it's continued, but
More complicated than you anticipated?
I think it's just less user friendly maybe than,
It
but-
is.
Oh, that's a
but
problem.
that's,
But it's a
I
new
don't know
system,
if
right?
that's really unexpected.
We spent a lot of time with the State Street folks going over these, and, they're building us reports too, and then teaching us how they did that, so. I think we've gotten over that learning curve for the most part.
Okay, but you don't want a reporting product that is limited to very few people that have the knowledge to use it. You
So
want
once you have those reports in place,
uh,
they're very easy to funnel out to the teams and things and say, oh, here's your report, all you gotta do is click a button and update. It's that initial learning curve and setup, I think.
So Aaron, will you eventually have the ability to create your own reports once you've learned exactly
yeah.
how the whole thing
We've
works?
already
Is that-
created
Matt's already
for sure. And as a backstop, we have our State Street team to help us create those, and there's several members on that. And if they need a further backstop, we have the actual Slovis team. So, yeah, there's plenty of depth there, but you know, obviously we want to understand it as well as we can.
But I think, Mr. Executive Director, a discussion about, okay, we're selling you this great reporting tool. You know, just communicate with them, we're expecting something that's easy to use, easy to understand, and that sort of thing.
I think our limitations on this is it's infinitely better than what we have.
Yeah.
Is it everything we dreamed and hoped it would be? No, but we're also still learning it. So, you know, I think in a year or 2 years, it'll be, you know, riding, I don't wanna say riding a bike, but, you know, something that's repetitive and,
And Aaron isn't going anywhere, right?
No.
no, we already have it. If we
If
get a
he
reference
is, you
call.
need to stop him.
But it's a relatively new product anyhow. So, I mean, we know we have to work out all the bugs and get it to where we.
Absolutely, and just talking with other public plans, when I went to the State Street Client Advisory Board, they're having some of the same issues on getting up and running because of how much work goes into that. But, you know, they also like the system quite a bit. So.
And to John's credit on this one, we're not just leaning on Aaron to do this, to use this tool.
Right.
All of the team will be required to be able to do it, so we're broadening.
The basics.
We're broadening the utility.
Well, that's what I mean, you want it to be used broadly.
Yeah.
But broadly is, if it's a complicated tool, then, you know, that takes a lot of effort to understand.
Okay. And along with that, I guess I just also talk about Slovis Risk real quick. So Dan Zarling's running that. We've got that up and running. We've got kind of initial high-level summary reports, which again, better than anything we had before because we didn't have anything before from the risk system thing. And so that's going well, I think. It's, you know, constantly just kind of, it's really about tweaking what they're doing and making sure that they understand sort of how to reflect the assets that we have to the risk system so that it accurately reflects, you know, what we have in the portfolio. And so making a lot of progress there. Hope to show you some stuff on that as well going forward. So that's it for me for the moment. If you don't have any other questions, I'll turn it over to Aaron.
Well, as per usual, I'll just go through the key takeaways, but feel free to ask any questions along the way. One thing I might add, just since we're on the Slovis topic, Slovis is going to be able to reproduce this attribution as well. So I've tested, this is the one that I created here in-house and have been completing it, but we can also use Slovis to do that now. So that's going to make things, that's going to save some time and make it easier in the future. So starting out with strategic asset allocation, what I'd note here is just real estate and cash are the only benchmarks to have positive contributions to the policy neutral negative 13.5% return. Tactical asset allocation, over the course of the year, we were slightly overweight real estate and private investments, which is not surprising given how real estate has done and the lagging in the pricing of the private investments. And overall, the overweighting, underweighting of the asset classes relative to their midpoints increased the pensions portfolio return by 33 basis points. I did incorrectly write that it decreased the pensions portfolio return by 33 in the takeaways, but just wanted to point out it increased it. And that's mainly attributed to being overweight real estate and being underweight non-core fixed income and being underweight a negative performing benchmark has positive effects. So that's why positive effects there. Style selection, I guess the only thing I'd probably highlight here is the one thing you see standing out, real estate. The underlying benchmarks for our real estate, for our REIT and commercial mortgage-backed security managers are public, and they're being compared against our private real estate benchmark. So, you know, we could kind of expect to see these larger effects there. Manager selection, there isn't a whole lot to mention here. I guess I'd point out that our internal fixed income portfolio had good relative performance and added 20 basis points in outperformance at the pension level. So it's a way to go, Ramosto person and team. I guess my advice paid off. And our private asset classes clearly added a lot of outperformance over the year. A decent amount of this outperformance can be attributed to the lag in pricing of the private investments versus their public benchmarks. But over the long term, our private asset classes have been very strong performers. So I definitely don't believe it's just the lag in pricing that's bringing those outperforming effects. If there's no questions, that's all I have. Thank you.
Thank you. Hey,
Good to see you again. Mr. Chairman, members of the board. Thanks for having me again this morning. I'll walk you through the next just a couple of slides on the private investments portfolio. On page 19, or slide 19, you will follow. Start out with the overall private investments environment. As you probably remember, we're coming off of a record year. 2021 was nothing but a record year in terms of deal activity, pricing, whatever have you. So I'd call it normalizing more back to levels that we've seen prior to that outlier year, specifically in the buyout space. Last year was driven by post-pandemic stimulus, cheap debt, or low interest rates. So all of that is changing a little bit. So we're more normalizing in terms of what we've seen prior to 2021. In terms of valuations, we see continued intense competition for the deals that are being done or are being made. So that is reflected in high valuations. You see that in the bottom right-hand chart. We are top end of that historic range. The same is true for the use of debt or leverage, also at elevated levels despite the rise in interest rates. So that was a little bit of surprise that hasn't come down yet. We expect it to come down somewhat. Obviously, I don't have a crystal ball. I wish I would.
You know the magic words, I don't know.
It is, yeah, unfortunately, that's what it is. But it takes a lot of knowledge to have knowledge that you don't know. And go forward, overall environment, we expect that to slow down somewhat, specifically in the fourth quarter. Oh, that's true. As John already highlighted, a lot of our peers, limited partners, are facing the denominator effect. So we are bumping up at the high ranges of the allocation, and a lot of folks are reevaluating how much are they committing, go forward. Commitment check sizes, are they going to be smaller than in the past? So we'll be looking at that as well. Weekly communications with the CIO, Director of Risk Operations. Again, to John's point, we're not going to not commit next year. It'll just be somewhat in the range of what we've done historically, in line with our pacing study that we're doing with RBK. Are there any questions on this particular? I'll move on to the next page. Performance, don't want to belabor the point here. Performance is very good. We're proud of it. Attract your attention to primarily the longer term, 10-year plus since inception type returns. As we all know, there's a lot of lagging effects, J curve. All of this is messing around with the shorter term periods ultimately, but 10 years and now since inception, very strong, relatively speaking, as well as in absolute terms. And keep in mind, these are all net of all fees to Montana.
And inception is 2017?
This inception run here by RVK, I believe, goes back 20 years now. It's May 2002. So it's a 20-year number, annualized, net of all fees, 13%. Fairly happy with that. It's additive.
Jeez, it should have been 15.
You weren't here.
I wasn't here for the entire 20 years, no. I can't take credit for all that.
Some board members were.
Then you can take credit. I'll move on to the next slide if that's okay.
Can't we just end here?
Yeah, that's fine. It's just a summary of the overall portfolio. Again, keep in mind, we're doing a deep dive once a year where we dissect the portfolio in much, much greater detail and offer the opportunity for the board members to ask questions, have a conversation about any specific topics. This is really just a summary slide. You see the numbers on the page, roughly $2 billion as of quarter end. It's about 18-ish% of the pension. So we are on the top end of the range. Again, as I mentioned, well aware of that. We're managing through that. Portfolio is broken out in rough numbers, 65% buyout across the size spectrum, 20% in private credit, and about 15 or so in venture capital. We'll continue to focus on the North American space. No major changes here since the last couple of quarters. Also, emphasis on primary direct fund investments. We do have some fund-to-fund exposure, and there is a place for that in the portfolio, but the broad majority is direct fund investments. You see the net cash profile was negative for the quarter. That is not unexpected. We had a lot of new commitments this year that have started to call upon those commitments. So we saw a ramp up in the third quarter in terms of capital being called from us. Year to date, we are positive $75 million in terms of cash flow for the portfolio. The two new commitments, we spoke about Audax yesterday, and Jack hopefully remembers our discussion on Deer Path from October. So those were the two new names in the portfolio. Any questions?
So, back in the back part, the appendix part of this report, so on page 60, it has the private investments by sector. So the biggest position is in consumer discretionary. What would be examples of consumer discretionary?
Anything you and I buy.
You
You don't buy anything? Okay. So that's.
I'm on fixed income.
He's a senior on a fixed income.
Consumer discretionary, oh God.
Leave the guy alone, for God's sake.
Truck toppers, yeah, I just bought one last year, a topper for my little pickup. Any kind of auto aftermarket, we have a manager that's specialized in that area. Gutters, rain gutters for your house.
Okay, but it's the largest sector here.
It's, yeah, because the consumer is driving the majority of.
We're buying a lot of gutters.
It's not, that was the first example. I don't know. So, it is, it's GDP's largest piece, right? People buying stuff.
Okay, and it's a position in the private side, private investment.
Yeah, I mean, your typical small business that is driving the economy, right? We forgot the numbers from the last board meeting, but there are thousands and thousands of small businesses in this country that are representing the economy, and they would all fall in there as soon as they have a product that falls in that category.
Thanks.
Any other questions? I see none.
No.
Thank you very much.
Thank you.
All right, I'm pinch hitting for Ethan again. I think we're a little bit behind, so I'll try to pick it up a little bit. But real estate on slide 22, I will just say, there's some price discovery, I think, going on in the market right now with real estate. You see that between the public REITs and the private sector stuff, as we kind of talked about with some of the performance numbers here. So, big differential between where the REITs are priced now because public equities have gotten whacked as interest rates have gone up versus where the private stuff is. But broadly, real estate in the portfolio on the private side still performing very well. Buildings are generally full, people are making their lease payments, so no real issues within the portfolio. But I think buyers and sellers are trying to figure out, well, my building was worth X before rates went up, now cost of capital is higher, what would it sell for now? And they're not always, sort of meeting at this point. So that transaction activity has slowed down because of some of that effort to discover, well, where is the real pricing at this point in time. So I do think it comes down a little bit, as RVK was talking about, in terms of the overall performance in the real estate portfolio, but not to the extent that equities or something have fallen, I don't think. So truth is probably somewhere in the middle between kind of the public REITs and the private side.
Let's talk to the delinquency rate. Is that just delinquency rate on payments, like your mortgage payment? That's the third bullet point down.
That would, I believe, be generally, well, I think he's mostly talking to the delinquency rate on the debt that's on those
Oh,
buildings.
yeah, that would make sense, yeah.
Slide 23. Obviously, return's been very strong and, you know, it's really good over the 5 and 10-year number there since inception. We've always tried to dig ourselves out of that little hole, but we're getting there, and one of these days it'll be green, so no concerns there. Approximately a $1.7 billion portfolio, as it's been, you know, fairly US-centric, well-diversified. I know we talked about it a little bit yesterday, Terry, but, you know,
I see.
slide 64, the breakdown.
I just
you
saw
know,
that, yeah, 25%.
Yeah, pretty well diversified. And we talked about the Equus commitment yesterday. So I'll stop there. Any questions on real estate?
Seeing none, moving right along.
All right. Real assets, you know, a space that's done quite well for us, particularly all of the commodity-based strategies that we have been in. Probably the biggest news there has kind of been around oil, particularly Russian oil and gas, and the $60 cap that has been placed on them now. I think the market took that fairly favorably because it wasn't so low that the Russians were going to pull all of their product off the market, because eventually that makes its way, I don't care who you sell it to, it makes its way into the global market one way or another. And so broadly speaking, that, you know, kind of tames inflation, because we're not hopefully going to have higher oil prices, thus higher gas prices. And so that certainly has been a help to the market broadly. Good performance overall from a lot of the various strategies here. I'll just open it up for any questions.
In real assets, there's a lot of categories you can be in.
Yeah.
Are there, looking forward, are there particular ones that you're looking at now?
Well, I think, as you know, we've probably been a little more focused on the infrastructure type categories. And so we brought a few of those to you, so that still remains, say, a little bit of a focus there. But we do have some oil and gas names that are coming back to market. Now, there were a lot of poor performers over there in that space over time, but there have been some standout managers, and so there are a few of those coming back to market next year that I think we will take a hard look at. Within kind of the broader context, to take it outside of CAP, we've got our rail car manager. We met with them a few weeks ago, doing very well. You'll remember that, so CAP is in that strategy. Trust fund, we have approved real assets, but we didn't do that before we were in that rail strategy. They're going to come back to market and open that fund up for some additional capital. So I think both trust fund and potentially state fund, as we talk to them, if we end up adding that real assets as an allocation there, then we may have an opportunity to put some of that to work later, maybe later 23, early 24.
Okay.
Performance, again, very good over both the short and long term. I won't dwell on that. And broadly, slide 27. Nothing foreshadowing, I don't think, here to note. We talked about the CBRE Muscle Shell infrastructure investment in October. That's the digital infrastructure strategy that we've got a separate account in now. But happy to take any additional questions on real assets.
Seeing none?
Thank you. If I can refer the board to slide 28. I'm not going to go over all of the environment. I think we've hashed that over pretty good already. The only thing I wanted to call out on slide 28 was, again, the parallel shift in the yield curve. Yield curve went up dramatically, but not all across, not the same across all the curve. At the end of the quarter, the inversion between the 2-year and the 10-year was 45 basis points. You get 45 basis points less for buying a 10-year than a 2-year treasury. Before I came in here, it was 82 basis points. So that's as large of inversion as we've seen since the very early 80s.
Like right now?
Right now. So why do I call that out? Well, because we might look at interest rates on some of our portfolios and say, hey, let's lock those in for a longer period of time. And I think that's a good idea. But to do that, we're going to give up that yield. So making that decision is a lot tougher than it would be if we had a positively sloping yield curve.
We don't want your life easy.
No. Why does the market hate me? I don't know, but it does. Going on to slide 29. Only thing I wanted to call out there, well, I'm going to call out a couple of things. One, mortgage-backed securities, we saw a significant widening in the yield for those. That's not unexpected given the uncertainty of the direction and magnitude. More of the magnitude of interest rate changes than the direction. And so just call that out. And then of course, call out the negative 14.6% return on the aggregate for the Barclays Agg for the year. Going on to slide 31 for some performance. The core fixed income had a negative return of 13.36% on the year. The internal portfolio outperformed by 133 basis points, which Kirsten points out is still negative, but good relative. Reams outperformed as well by 65 basis points. The outperformance was mainly due because we were short duration. And as interest rates went up, we were less exposed to those, so we were not as negatively impacted. So I had, happy to take any questions on for fixed income.
So how many years have you been doing this?
21, going on 22.
So you've never seen the Barclays Agg anywhere near this sort of a return in your career?
That is correct.
Yeah. What was the worst it's ever been in your career?
I want to, don't quote me, but I want to say about -7.
Okay.
So.
Yeah, I mean, this is unprecedented, right? Yeah.
Weren't you glad to be part of it?
Yes. What a great opportunity for learning.
But he's more happy to be part of such a supportive team.
Yeah.
Good morning, Mr. Chairman, members of the board. I'm on page 32. Start with non-core fixed income. Obviously, you've heard a lot about the environment. The big picture, what's been driving markets, inflation, higher interest rates, and what the Fed's going to do. That applies to everything, and it's been what we've seen this year. How it's impacted non-core fixed income. First, a higher volatility. In U.S. high yield, the range of the high and low spreads this year has gotten about 300 basis points. Last year was about 100 basis points. Issuance has all but dried up. So issuers are very reluctant to come back to market and pay higher borrowing costs. The market has been especially rough for emerging market debt, which is dealing not just with inflation and higher rates, but with geopolitical issues with Russia, Ukraine, and China, as well as a stronger dollar. So all this has been, obviously, we've heard a dismal year for returns across all asset classes. The good news is that yields are up, and and high yield bonds were yielding above 9% at the end of the third quarter. That's come back a little bit here in the fourth quarter. In addition, high yield is trading at a discount to par. That's something we haven't seen in a long time, which provides some measure of downside protection as well as some incremental return. As your bond matures, if I'm paying 88 cents on the bond now, as it matures, I'm gonna get paid at par. That's an added benefit too. Default rates have been low, but the big question is what will happen in the economy, how much of a slowdown we'll get, or how severe of a recession, and how that will affect default rates. Those are the big issues that we've seen in non-core fixed income. For performance, you see on page 33 and 34, high yield bonds are slightly in the red in the quarter. Active management was good, with 4 of our 5 managers outperforming their respective benchmarks. The story in the third quarter, and this has been the way for the last year or more, has been emerging market debt underperformed the asset class benchmark, which led to the asset class underperforming in the third quarter by 72 basis points, by a little bit more than that over the trailing year. That has reversed a little bit in the fourth quarter. We'll see a bit with if that holds, but we've had a pretty dramatic reversal under emerging market debt here in the fourth quarter. No change to the roster of managers or inflows or outflows in the quarter. One update would be that we've made significant progress in finding a manager for an allocation to convertible bonds. And I would expect and hope that at February board meeting, we'd have funded a manager in that space. Any questions on non-core fixed income?
Okay.
Page 35, domestic equities. Again, the market drivers, how aggressive the Fed might have to be. John completely stole my thunder, and the good news is bad news. That's applied to non-core fixed income as well. But when we get negative news with respect to inflation, markets tend to trade off, and we get some expectation that maybe the Fed might not have to be so aggressive or keep interest rates longer for higher than markets have rallied. But the reaction this year, what's driving markets is the rising interest rates, which we've seen in a drop in price to equity or price to earnings ratios. Earnings growth has been positive this year. So all that reaction, the downdraft really in equities, has come from lower multiples. What the markets haven't quite fully incorporated is what might happen to the economy and how that might affect earnings. Earnings estimates for 2023 have come down since what they were in the middle of this year. But the question is how much of a slowdown we might get and what the impact might be on earnings and how much more earnings might decrease from this point. The 36 and 37 asset class outperformed the benchmark during the quarter, about 10 basis points. That was from small cap overweight, which was beneficial in the quarter. It's been a little bit more of a drag last year. Page 38, again, we're all indexed investments in domestic equities, modest overweight to small caps, no change in the manager roster in the quarter. The inflows and outflows basically were a minor rebalancing activity, which John alluded to. One thing, we had a small cap index fund that was moved from a commingled fund into a separate account. So now all of our domestic index funds are in separate accounts. And John mentioned the change that we made here in the fourth quarter in our small cap ETF. We opted for a cheaper one. The give up is, well, there's a little bit different exposure, maybe not the liquidity of the one we'd had. We're not big traders. We're not frequent traders. This is a good trade-off. It saves maybe $100,000 a year. in fees. Any questions about domestic equities? Moving to page 39, international equities. Again, the same drivers, geopolitical issues more affecting international than domestic equities. Chinese economy that's dealing with a distressed property sector and the tight zero COVID policy, which maybe loosening that some. Chinese stocks were down over 22% in the third quarter, which led to emerging markets underperforming developed markets. Dollar strength, again, has been a headwind to international equity returns. All of these have combined to lead to international equities trading at a steep, deep discount to U.S. equities. Largest one we've seen in decades. Performance, page 40. We're about flat with the benchmark international equities in the quarter. Just outperforming by about 2 basis points and underperforming for the last year, largely due to one of our large cap growth managers. No real themes in the quarter in terms of what managers or styles outperformed or underperformed. It was what I would say would be mixed. And moving to page 42. But a roughly equal split in indexed and active. Positioning has been the same in the third quarter as it has been recently, with a modest overweight to small caps, close to an equal weight in emerging market exposure. No changes in the roster of managers. Again, some minor rebalancing activity, which John spoke about. And we did change our ETF for developed markets to a cheaper one. Again, it was kind of the same trade-off, that we get a little bit different exposure, but maybe less tracking error, which is I would say would be a positive, but lower fees, and that saves maybe $300,000 a year, I expect, which is significant.
So it'll cover your salary.
Well, the 20% of that goes to the bonus pool.
Yeah, the bonus pool. You bet.
For the board.
All right, anything else? Questions? Kirsten?
Well, it's hard to look at these numbers because now that we're in December, SIP's moving so quickly. These look very outdated to me. At the end of September, our yield was 2.72, or more than 100 basis points over that currently, flirting with 4% yields in STIP. Also flirting with $8 billion in STIP now, might hit it tomorrow. So very close. A lot of that, of course, is Treasurer's Fund. So you would note here, local government participation looks like it's down. It's not. It's just
It's a percentage calculation.
yeah, the denominator effect with the state. The Treasurer's Fund is just so huge. It's over 45% of STIP still. Our STIP reserve is up to over $59 million. We are reserving quite a bit, getting that up there. We did underperform the index over the last year, which we would expect in this very fast-moving interest rate environment. We're significantly longer duration than our benchmark, which, as Ramasco calls us, the feed the bulldog ideal here. Current yield matters just as much as future yields. So that is why, and we'll make that up as soon as the Fed pivots or even indicates that there will be a pivot. So happy to answer any questions. Making it nice and fast for you, you might get back on track.
My question is, how much coffee have you had today?
Only 2.5 cups now, so not bad.
I think it was 4 yesterday.
I guess.
Well, she's been up since probably 5, so.
Before 5, yes, exactly. And I spent almost $500 million today, so feeling great.
Talking about consumer discretionary.
Yeah, Carpenter mentioned that it looked like I was buying on Black Friday, and I said, kind of.
Wow,
Great,
all right.
thank you.
On slide 45, talk briefly about the state fund. All of the dynamics of the market still in place for the state fund. But please do recall that the state fund also owns equities and real estate. In fact, you can note that the real estate and the state fund almost returned 21% versus significant losses in the investment grade portfolio of 10.41%. Good relative return, but still significant negative losses.
So in the retirement plan is returned to -8.4. So the reason for the larger negative here is that we have more holdings in the fixed market. Is that fair to say?
Well, I defer to Aaron's chart on where the returns come from, but my bet, Mark, would be that less percentage real estate might affect. But yes, fixed income markets were very bad, and they hold about 75% core fixed income. Yeah, any other questions on the state fund?
They also hold equities, Mark, which trust fund does not. That's true too, so that was also a big negative.
Oh, on state fund, I know you've had some meetings over this last year with them. They're happy with what we're doing now.
We'll find out tomorrow.
I don't know.
I would say productive meetings.
Yeah, you think it would.
Their state fund is a client that needs very good structure of, here's when we're meeting, here's when we review the investment policy statement, because if not, it gets too fluid for too long, and it will consume all of our time. And it's not that they're not important, but that structure is an important part of our relationship.
Are you proposing a structure change?
We are going to propose a couple, well, several, but the main ones being we want to add, we want to change high yield to non-core so that we can add convertibles. And we want to change the benchmark to the longer duration Barclays aggregate as opposed to the current shorter duration Barclays intermediate.
We'd like to add an allocation to real assets for them as well. Infrastructure type real assets that will be yield oriented type.
Okay. And that fits within their legal requirements for investments as an insurance?
They can own them. So RBK actually did a analysis for us for the RBC ratio to see what the impact was for the changes that we've made, which we've gotten the report tomorrow if you come to the committee meeting. Okay. I don't want to give it all away ahead of time. It's pretty exciting.
Okay.
Going on to the trust fund, all those similar dynamics in place. The trust fund, much larger percentage allocation to real estate. So we wanted to talk a little bit about the underperformance versus the index. Index being the Odyssey index. So you'll recall several years ago when we came to the board and wanted to increase the allocation to real estate from 7% to a maximum of 7 to a maximum of 30, and had suggested, well, we're going to go closer to the higher end of that range, but asked the board's patience in timing of how that was going to go down. So that went way, we did that quicker than at least I had envisioned at the time. And we did that by by putting money into some large open-ended core funds that were able to take cash. Once we got that money in, then we started allocating to value-added core plus type of funds. And so you'll recall that those type of funds, private equity type of funds, in this case, private real estate, have a J-curve effect. And so that's a big chunk of that, is that J-curve effect from that money going in a very condensed period of time. And then also, some part of that is in real estate debt, which we always expected to not have as high return as core plus real estate, but have a more steady return. And as Kirsten mentioned, we've got to feed the bulldog. So that was the thinking there, is that will provide more immediate returns, albeit higher than fixed income. So probably never expected to equal or beat the benchmark in the early years of that move. So not surprising, I would say, that we didn't make that benchmark. Happy to take any questions.
Any questions? Okay, John, anything further? Okay. So before we go, there are four of us who our terms expire at the end of this month. We serve until we are replaced, but at least it's my completely uneducated anticipation that we will be replaced before the next meeting. But I know, I just want to know if any of the four of us, Terry, start with you, have anything to say before we go.
I hadn't thought of this until yesterday when you said it, but I started paying attention to the Board of Investments 44 years ago. I did, as a legislative council researcher, I did a study of the Board of Investments. And then when I was I was chief of staff to the governor, and obviously the board was important. I was the fiscal analyst, and then I've served 12 years out of the last 16 as a board member. And it was really interesting to think back 44 years. I remember going over, they used to have their little office across the street from the Capitol, and they had the green, what's it called, the green bar papers, the computer papers. And I swear the staff was bigger than 3, but I'm not sure it was. And and then, to watch the evolution over time. And I'm really proud to think of some of the decisions that have been made. Like, Thomas just brought up, we've been in private equity for 20 years. I mean, to think that a little fund like Montana was a leader in that is really kind of cool. And I still am very proud of us, and I think I made the motion, but I just think I was the first one to say it, that we would not go into hedge funds. And we took a bit of flack for failing to do that, but it turned out that was the right decision. And I really think we have made enormous strides in the governance of the board, getting the balance of what the staff does versus what the board does. I think we've come to a very good place there. I also think the evolution from having our entire stock portfolio run by one person to having a mixture of active and passive specialties. I think we've been very open to new asset classes, but appropriately conservative in going, we didn't buy any coins or crypto or, wow, nobody even mentioned them. Think about that. So I just feel really happy to see where we are 44 years later. And the fact that the performance has been good, the staff is cohesive, the board works well together. I think that is really an achievement, and I've really enjoyed being on it. It'll be fun not to come to meetings too, although I'll miss you all.
Ruth?
Well, it's interesting because Terry and I have had the same perspective, working over in the Capitol in the governor's office, watching the Board of Investments over the years. And I want to say thank you to Dan and John and staff in particular for your great work, both before I got here and since I've been here. this is not necessarily an area that I know much about. And so the fact that when I came here, I understood about 1 out of every 4 or 5 words you said, and that now I understand about 1 out of every 2, I think is real progress. And I feel good about that, and you can take credit for that. Also to Becky and Paige and Jim and the folks at RVK, thank you for your great support and the opportunity to provide us with an independent perspective on things is extraordinarily important to the board. And the longer I've been on here, the more I came to appreciate that role and how good a job you did of it. But the most important thing is my fellow board members, especially those of you who, took some time to help keep me on the rails. It was about 10 minutes, as I was telling Carl and Dan last night, about 10 minutes into my first meeting, Louise, as you recall, where you were talking about earmarking and the origin of the concept of earmarking in legislation actually related back to earmarking livestock by making different kinds of marks with a knife in their ears. And, I'm 10 minutes into my first meeting and I immediately jump in and tell a story about my grandfather when I was a little kid at branding, threatening to earmark me and the other grandkids when he got done. And as I was telling that story, Carl and Dan were looking at me like, what the hell did the governor do appointing him to this board? So it's been a great opportunity to learn, and it's been a great opportunity to make friendships. And most of all, to my fellow board members, both those who aren't with us anymore and those here today and those to come. It's a heck of an opportunity to learn, and it's a heck of an opportunity to serve. And I was really privileged to have that opportunity. So thanks, everybody.
Diane?
Oh my gosh, I like Terry, have been watching this board for years. And maybe through a different lens as the labor representative. And that means I'm watching you all. On behalf of workers who depend on pension plans and government that depends on the way you manage the funds, the STIP funds and things to enrich and stabilize those things that are important to workers. And so I remember reading old minutes of the Board of Investments. And it was a much simpler time, not that long ago. And so it's been exciting for me to be a part of this and watch and see the diligence and the perseverance and mostly the great collaboration. When we were looking for a new exec, I went out and watched other board meetings around the country to see, okay, how are other boards operating? And how do their, execs perform and what do they look like? Well, I was shocked. Nothing like this board. I mean, there was chaos and controversy like I've never seen and never expected to see here and haven't. And I give that tribute to the depth of experience and the breadth of commitment that I've seen throughout the board, throughout all of the staff, and our investment consultants. You've been wonderful here all the time and want to keep coming. It's been a wonderful experience for me. And I leave with even more confidence in this board that I had coming in. But I've watched the work of the board for years and just been so proud of what we do and what we are. The collaboration that happens, the continuous improvement, the clear, open dialogue that we have. It's just been a wonderful experience, and I really appreciate all of you. I'll even turn and look at Cliff. As I watched Cliff report all those years at the legislature and at TRS and para, I mean, I've been proud since you were there. That's when I first started watching, and it's just, the quality is maintained. And I expect to keep watching, and I will. So thank you all. Appreciate each and every one of you.
Well, I figured that after these three, I'd probably just get to say ditto, but I have not been watching the board for 44 years. I confess that I didn't know there was a board until I was appointed to it. First of all, to the fellow board members, it's been a wonderful experience, and it continues to be, and I wish you all the best of luck, and I particularly wish those of you who stay and remain, continued success in your work. There's an art to doing this, of questioning and probing and making sure we fulfill our obligation, while at the same time understanding that we're not here every day and we have no business in getting involved in the day-to-day operation of the place. And that sweet spot there has been a place that the board as a whole, the whole time I've been on it, as a whole, the board's done a pretty doggone good job of. This board, I think this group of people in particular is in that sweet spot. And I attribute that to the quality of the people that are on it. And so as I leave and you get a replacement, I just hope that you get people of the caliber that you are to continue on. And now to the staff. My respect for you and the work that you've done has just grown over the years, not because I didn't respect you coming in, but I didn't know what you did. But you've demonstrated that our faith in the discretion that we give you is fully justified, and then some. This is a very weird way to get to know people, but it's been a pleasure to get to know you in that way. The same drew Becky and the folks at RBK. You've made this part of the job, staff, so much easier. We had a board member once that talked about having to sleep at night thinking about this. I've never had that problem with you. So it's an impressive group of people, and I wish you, again, nothing but success in the future. As to my time as chairman, I think what we've discovered, what's been demonstrated, is that a good board and a great staff is the formula for a successful organization that not even I could screw up. So thank you all. It's been a great pleasure. I wish you the best of luck. And that's it. Do you have a question?
No. Mr. Chairman. Diane, Terry, I've only been here a short period of time, but I want to, you really made me feel welcome, and I appreciate the stable efforts that you put into this board and provide stability to not just me as a new board member, but to the staff. And it could have been a very challenging with the turnover in administrations, but I think the governor did the right thing to keep people on the board here to make that stability, keep that stability in place. And, you know, I appreciate the leadership. And I hope that we can continue on with that, with your legacy.
Ditto.
Okay.
Ditto.
Ditto.
We have to say ditto.
Okay, so, do you have a to-do list?
Not really, other than.
Okay, well, I don't really care. Well, I do care.
I'll miss
know
you
that.
too.
Is there anything else we need? Okay, with that, we're adjourned. Thank you all.